mentioned this before at the first class. I have a company called Dark Horse, and I think I mentioned the reason it's called Dark Horse is because if you do horse racing, if you bet on the dark horse, it means it's a horse that maybe people don't think is going to win, but somehow you see a winner out of that horse. And if you win, hopefully you win big because the rate will be good. And if you lose, then unfortunately you do lose all the capital. And that is, in my mind, I think that's the essence of angel investment. You are in for hopefully for a big return, but you are also already prepared that you might lose all the capital, and it's okay so long as you don't lose on every single bet. The idea or the fight, or should I say the economics, is that if you can have one or two big winner, that should be more than enough to cover all the other losses, and then you're still making good return. That's the idea. I mean, the same for angel investment, same for VC, not quite for private equity, which we will also touch on. Now, and then for those who read Chinese, the Chinese name is actually Bo or Bak Lok. And legend has it that Bo Bak Lok is a person who are very good at looking at horses and finding the winner. They call these horses the 1,000-mile horse, 千里马 or 千里马. Okay, so that's why we thought, hey, that's a good name to go with, rather than just calling the Chinese name a black horse or something. Okay, now I will skip the first few slides, which you have seen already. It's just a bit of self-intro, but I want to highlight again the connection with Science Park Cyberport Design Center, and also Angel Investment Business Angel Network. It's also a good channel of sourcing some deals, because some people ask, hey, how did you find the deals? Do they knock on your doors, or do you have to actively find deals? And so being active in the startup community really helped. So I get to know a lot of people, and actually not to get to know a lot of startups. And also on the selection panel of Science Park. However, there is also something I have to be very mindful and cautious, is that for some of the program that I sit on, there is actually a conflict of interest. So in actual fact, I'm not allowed to invest in these the startup that is on the incubation program or a venture fund for at least 6 months. So I can't, I'm not supposed to invest in them for at least 6 months. I think that's to be fair, because there is a conflict of interest if I sit on some panel and then I invest in that same company. So there are very strict rules around that. So, but nonetheless, it's a good source to get to know a lot more startup that I probably have not sat on their panel. Okay, so what is Dark Horse, right? So it was incorporated in Hong Kong, but I want to tell you, of course, we are angel investors. I hope we don't just throw money away from the sky. I hope that we are a lot more cautious in terms of what sort of company we actually invest. Okay, that's angel investment. Now, I want to tell you how it started also. It started in 2008, around May time. We didn't start as an investment company. We start as an angel club. But back in 2008, just 12 years ago, if you ask people in Hong Kong what is angel investment, very few people would be able to tell you, hey, what angel investment is about. Nobody even understand the term. We didn't quite understand the term either in 2008. So we started because a friend of mine has a startup, and he was actually raising money. I would tell you that was kind of my first angel investment. And so I started to ask other friends who might be interested. Now, at that time, even now, most people, invest in in stock market, invest in property. These has been the main kind of investment vehicles, or people make big money out of these in Hong Kong from stock market, from the property, especially property. So, but then some people start to see, hey, investing in direct investment, not something that is not listed, something that is not a property. It's getting momentum in US, because you see a lot of big companies becoming very successful. And then if you can invest before they go IPO, before they get listed, you might potentially make a good return. So people starting to get curious. And before we become a company, we start as an angel club. That means we will actually just find friends or friends of friends who are also interested in angel investment. So it's more like a social gathering, and then we will pass on potential deals, and then we will talk to people how much you're going to invest and so on. And it's a good meeting over dinner. But soon we realize not everybody is serious in the sense that who want to actually get involved. Like, I mean, if I say I have a meeting with a startup and we're going to actually meet the entrepreneur, hey, would you come with us to sit through the presentation or something? Or if we get someone send us a business plan in PowerPoint, in PDF or Word document, we pass it, we circulate through our club member, and then you realize only very few people actually read them and give you feedback. So we thought, hey, that's not really fair in a way, right? And then when you ask them, if you have a deal, if you ask them if they invest, and then they would say, you jump, I jump, you invest, I invest, kind of thing. So in other words, I'm describing there are a lot of people there curious, but they are really just free rider in a sense. You do the hard work, you go to meet the investor, you do the due diligence, and you write the term sheet, and then we'll just tag along. Now, of course, because we are not set up as a company and we're just doing like more like a social club. In that sense, if you are doing the hard work, if you are sourcing the deal, if you're putting all the sweat and then someone just come along and ride on that, you're not getting compensated for that. And then why should we do that, right? It just doesn't make sense in a way. So we decided, in fact, I decided, let's see who have been, very responsive, who are actually a little bit more serious, who come along with you to see the investor, the entrepreneur. And then we say, hey, maybe we are the only one that are serious about this. So maybe let's sit together and form a smaller group. And in fact, let's form a company. So we decided there were just actually three of us, and each of us also bring another friend who are actually very serious. And so we end up having 6 people, but we are very serious about this. Meaning, yeah, if you need the capital, we will give you the capital. If we need to see people, response to a business plan, do due diligence, we would be there. And so the 6 of us come together, and initially, which actually I thought that was a good name, by the way. We actually were not called Dark Horse. Initially, we were called Asia Angel Alliance. Now, there's a reason for that. First, you can see the initial, it will be AAA. The AAA is the highest rating you can get, right, from rating agency. So I thought, hey, AAA is a good name. Also, we didn't want to restrict to just Hong Kong, so we call it Asia. And we do leave room to get more other angels to come together. So that's why we call it Asia Angel Alliance. Now, and then, well, we thought it was a good name. It was a good name. We put it, we even registered that name. And then we met a mentor of one of our partners, and he's a very experienced angel in Canada. He's Chinese, but he lives in Canada. And then, because we even call the name, the Chinese name, 亚洲天使联盟, so 亚洲天使联盟. So we literally, is a literal translation of the name. But then this mentor was telling us that, you know, the name Angel doesn't work in China, right? I thought, well, why not? I mean, we didn't think about this. And he said, hey, the name Angel doesn't work in China. And he said, because you die and you become an angel. Now, of course, looking at now, we know actually the name is widely accepted even in China. So people didn't associate the die and then become angel. It's just so we thought, oh yeah, people didn't like die to, you die and then you become an angel. So actually nowadays, no, people, you know, in China, the term angel investor is widely accepted. Even the Chinese version is widely accepted. Now, I just want to quickly show you the next slide, and then we'll come back to this slide, because I actually have thought of a very good logo for our Asia Angel Alliance. Remember, this is three A's, right? So I thought this logo would be a good one, right? You know, using the 3 A's and become, you know, make an angel out of the 3 A's. So just to tell you, yeah, I thought that was a good idea. You know, and then we even have a matching like logo, AAA. It was a good name. Now, I have to say, I also actually don't mind. I think the Dark Horse name is also good. It does sounds quite professional as well. Now, what I want to also tell you is, so we are not really a fund. We are a private investor kind of like friends group, right? So every time when we invest, we call capital. We don't raise fund. We don't raise fund and then we start investing. Because I will explain a little bit later. When you operate as a fund, there's so much difference because there's things that you must do and things that you mustn't do. We want to keep the kind of flexibility. Now, I would say, even though after 12 years, we're still young and still learning, but I want to give you a little bit background of the six of us. It turns out it was a good balance, because it turns out 3 of us were educated in US, 3 of us educated in UK, 5 from Hong Kong and 1 from Singapore. And collectively, we have experience of one of our partner has run a venture capital firm before, and he's now actually running another VC in Singapore. We have one of us has actually been in private equity. I'm in consulting. We all study technology or engineering or science as a background, and some actually has also run tech startup before, and then 2 or 3 of them actually also investing in the family business. So I think that gives us a very interesting, a good combination, because we are looking at technology startups. So everybody has some tech background is good. We are all, you know, overseas educated. That give us a good combination of, you know, Asia culture, European or Western. And then the VC, private equity and consulting background, definitely very useful in terms of understanding business and understanding returns on investment and so on, and some even running family business, right? So they must be looking at you know, investment as well as knowing the finance and so on. So that gives us a good combination. Now it turns out this is actually also an advantage in a way when because if you are good, if you're looking at some good startup, right? I mean good ones, then sometimes they are not short of investors, you know, then you are in a competition to, you know, against other investors. Sometimes you co-invest, sometimes you are competing. So when the startup actually, if they have a lot of choices, then they will look at which angel investors are actually most value add. You know, when I say value add, right, people often talk about there are dump money and there are smart money. So if a startup actually, when we say accepting dump money, that means, yeah, the investor is providing the capital, but not really value add, meaning they won't help you to open doors, they won't introduce network, they won't help you to solve problems, they won't do advice, you know, they just invest, and then hey, you run with the business and then bring back the return. When we say smart investment, usually it means, hey, you not only you accept the money from this particular investor, hey, this investor is going to help you to open doors, where they will introduce you to partners, to distributors, to whatever that will be helpful, and they will give you advice, and they will come back to you and try to help you to shape your business plan, how to advise you on your go-to-market strategy. That would be smart money. You don't just take the capital. You're actually going to get a lot of help. So if you are in a situation of selecting investor, naturally you would also try to get the smart money if you can, right? But sometimes if you are desperate, or if you already have good quite a lot of help already from other investors, then maybe you accept a little bit more on the dump money. I mean, I'm not saying it's a bad thing. I'm just saying, depending on your situation, if you're going to need a lot of help, if you want value add investors, or whether you are desperate for money, then it will influence your choice of accepting different investors. Okay, so now maybe I don't know whether some of you have seen this from other courses. This is a very typical kind of graph for different stages of fundraising. Now, sometimes people put revenue. I don't think that's right, because you can't have negative revenue. So I think it's more, it should be cash flow. Now, but then this may not even, it's not true for every startup, but it's true for most, I would say. Now, so let's say we start with, of course, the left-hand side, when beginning of time, when you just started your company. And you see you're burning cash, no doubt, because you have no revenue, because you have no customer, the product is not even out yet. Of course, you are burning cash, right? So you see the cash flow will go down. And initially, not so much, because you're just starting. But as you do more R&D, as you start rent and hiring more people, engaging potential production line, and you're paying for a lot of the professional services, and you burn money, right? And quite a bit. And now, even if you pass the stage of start having revenue, meaning your product is out there, you start having customer, you don't get a cash flow positive right away, because you still have a lot of costs. And so you need to ramp up your customer base. And then until such point, then maybe you get to be break even. That means your revenue can now actually cover your costs. Then congratulations, that's a big milestone. Because symbolically, that means from now on, your business can survive on its own, because your revenue can cover the cost, right? You don't need more investors' money. But so if you look at the break-even point, right? Now that's what we call the valley of death, because while you are burning money before you break even, who's gonna finance you, right? I mean, how do you survive through the valley of death, right? When you have cash flow negative, of course it has to come from investors' money. So investors' money would cover this, hopefully cover all this negative cash flow. I mean, essentially, you're burning cash, right? Now, so this is the initial stage of investment. This is where people call the seed capital. Usually, if you can break even, then in a way that is called proof of concept. I mean, your concept seems to work. You can cover your cost from your revenue, and then you will enter a different stage. So let's first look at the seed capital, right? So who's going to finance you, right? So I'm going to throw this simple question, right? Who is the first investor of your company? The very first investor of your own company.
Your own money and your parents' money, maybe.
Exactly, yeah. So of course you will be the first, right? And your co-founder, right? Your co-founder, if you have other people starting the company with you, and you no doubt first investor. And then who would be, now I can tell you now, angels is not your next investor. In some cases, yes, but most cases, no. So other than yourself and your co-founder, I think just now parents are already mentioned. So actually, this is what we call the FFF, right? So co-founder, not your friends and family. I'm just saying co-founder can be other people that just start business, right? So friends and family would be next, of course, right? So but you notice that there are 3 Fs. So the FFF, right? Who's the third F? Any guesses? Fool. Good. You know your stuff. So no, it's true. So friends, family, probably family and friends, right? And then fools are the 3 Fs that would invest in your company. Because I mean, who on earth would invest in a startup that has no revenue, no client, big risk, right? So only people who really trust you or want to help you, that's friends and family. And then if it's not friends, if it's not family, and they start investing in your company and the startup, they must be fools. Just to say, I mean, it's kind of a joke, but at that stage, you know, yeah, it's such a big risk. Why would someone take on that big risk, right? Now, I think when we say the angels come, usually the angel come not at the very beginning. I mean, the very beginning is co-founders' money. You must have already started at least something, you know, at least finish a business plan. Maybe you have already thought of how to make your prototype. Maybe, you know, so angels come very soon after you found the company, but not that soon. And also because you know, let's just take a guess, right? If you start, hey, if you sit with your co-founder and then you say, hey, we actually need investor, we actually need to find some money other than our co-founder's money. If you're looking for angel investor, guess how long it takes, right? From the day you think you need to get outside investor to actually seeing money in the bank. Yeah, that's a good guess. So, I mean, 9 months a bit long, but I mean, at least 6 months. That's not atypical. 3 months would be like super fast. So 6 to 9 months, if you are lucky, right? So that's more realistic. So therefore, during that time, you probably have already run out of co-founders' money, maybe, and then you will be accepting money from friends and family. And maybe, by the way, maybe it's not an investment; it's just a loan. It could be, right? So that's where what we call the seed capital round. Now, so if you're lucky and you actually get past the friends and family, I mean the seed capital round, and reaching break even. Now this is a typical. We will deal with the non-typical one later. Then you will say, hey, if this is proof of concept, I should expand my business rapidly, scale up, you know, be big, right? So, but then, you know, if you are opening a physical store, every store costs money. If you suddenly want to expand rapidly, it's going to consume a lot more capital. So this is not something that angel investor would finance. And you're now entering where this is what we call the venture capital stage. Now, therefore, be very clear. I know sometimes in Hong Kong, you hear people, even the government official, they would get confused a little bit about VC round versus angel round. They are asking a lot of the time. They're asking the venture capital to finance the very startup, and that is actually wrong. They're using the wrong term. You know, VC, yeah, they look at startup, but then they're not looking at the very, very young startup. VC typically like to look at something that has already somewhat get momentum. VC invests where a startup should be accelerating the growth. So this is what we call the early stage. Not something that at the valley of death. This is not the VC, but you do hear in Hong Kong a lot of the time people, they mix this. They say, hey, we have a lot of startup. Hey, we need a lot of VC to invest in the startup. I don't think they understand the stages and why. Now, okay, so I would also share I will do a quick economics on the VC. But let's just finish the discussion here. So yeah, you see that that's why the cash flow should shoot up rapidly. So the curve is much steeper, and because VC is going to finance you to expand, but a word of caution. This is also when a lot of company actually die because you are, if you're not careful, you are only accelerating the death. Because VC is going to get people to become very aggressive. This is the whole point. They are taking a lot of risk, but they want you to expand. They want you to conquer the market. And if you are not really ready, and if you are not really the type of leaders, this is a stage where they will fail as well. Now, I have met with startup when they are about to receive big money from VC, but then they were really shocked or scared because they're going to run suddenly the expansion plan is so vast, and also at this stage, if you have a proof of concept and when you expand that rapidly, suddenly you're going to lose a lot of money instead of making profit, because at this stage, if VC think you will eventually run a great business, they don't mind short-term losses in terms of like profitability. Expand now, shoulder the losses, but you make money later on a proven concept. Because when you first expand, you are going through that ramp up of customer again and so on. So actually in the short term, you will lose money, in fact, very likely. But this scares a lot of founders because we are trained to, like, your business should make profit, right? But what if you lose money for 1, 2, 3 years, but then you keep expanding? It's very scary for a lot of founders. So this is where also the founders have to change their mindset. And also in my mind, if you're running a big business, short-term losses is nothing because you are in the stage of investment. So you just have to deal with that and make a plan that would put you on the path of profitability. Okay, now if we now look at the next stage, when you have done the rapid expansion, nothing will ever stay on the high growth path. Just not physically possible, right? So you will slow down, and then we call that the kind of the later stage. But VC, I mean, you're still growing, but just not as rapid. And finally, you reach another stage where during the late stage, this is more we call where the private equity will come in. You need the amount of money that you need for expansion is now even higher than the VC round, because typically you would even probably need to buy out your competitor in order to stay on the growth path. So it's not uncommon that you see similar company would merge at some stage. You see this in Uber and Grab, and they would start merging and buying out other people's business in a similar area. But now we're talking about acquisition rather than just organic growth. And the amount of capital is going to be a lot more. So this is where the private equity. So later we'll talk about what would be the investment size or a typical fund for different stage. If you get lucky and let's say you continue on this path, then maybe you will go IPO, initial public offering. So now you are now selling on the public market, or then also private equity would have some of them will focus on this like second offering as well. So even after you go public. So this is a typical graph for different stages of investment for startup. And now let's deal with two things, right? One, yes, for cash flow rather than profitability, rather than revenue. Just want to finish one thing. I keep saying, yeah, you should break even and so on. But then there are a lot of exception in this so-called new economy, because like WhatsApp has never been profitable on its own, right? Instagram and even YouTube, and when they get bought, when they grow so big, and yet they have never been profitable. So in this new economy, it is true that for those kind of economy, the game, right? Because it's a social media game where for a lot of company, the number of active users is actually more important. However, I would argue that yes, it is true that WhatsApp, even it was sold to Facebook for $19 billion, where it has actually never ever make a profit. In fact, I think they have very little revenue, in fact, because everybody use it for free. And to continue on the WhatsApp example, WhatsApp has, from day one, they said they're not going to make money out of advertising. And they stay true on that path, even after Facebook acquire them. We still don't see advertising on WhatsApp, and I have never paid for subscription for our WhatsApp. But why is it worth so much, right? Well, two reasons, right? Number one, when Facebook bought WhatsApp, Facebook knew exactly why WhatsApp was important, because they have installed a lot of, if you heard the story before, Facebook has this VPN that they let people use, but instead they capture all the data from their phone. If you use the Facebook VPN, they capture all your data, and they realized people were using WhatsApp heavily, and therefore WhatsApp was a very strategically important app for social media, for communication. Anyway, that's cut the long story short. So Facebook knew exactly WhatsApp was a super important app on people's phone. And at that time, WhatsApp has 900 million active users at the time when Mark Zuckerberg actually acquired WhatsApp. If you can run an application where 900 million people use it daily worldwide, I think you have created something of huge value, even though you're not making money out of that yet. I mean, I will rephrase that. What that means is, it's not because you have been profitable. It's because you have created something that Facebook, for example, think they can absolutely not allow Apple, Google, Amazon to have it. Facebook must have this as a strategy, because if you think about if Google was actually acquire WhatsApp, what's going to happen to Facebook, right? So in that sense, it was a strategic move, but it was a defensive move as well. Then of course you're worth a lot of money. I mean, 900 million users worldwide on their phone. If you read the news, actually now it's 2 billion, or 1.5. Now it's 1.5 billion people using WhatsApp. So if you are on that kind of business, sure, you don't have to talk about your revenue, your cash flow, and your cash flow just going to come from coming from investors' money. Same apply to Uber. I mean, where they have never been profitable, but yet they get funded in every stage. They are investors are betting on somehow a profitable future, I hope. But it didn't work out for WeWork. So some business can get investors and some just can't. Okay, now any questions? And then I want to explain a bit on the VC economics and why VC would not actually invest in small startup. And then I will talk about what's called a funding gap. Any questions on this graph? Or I see a hands up on the, so yeah. Yes, Monish has a question.
I just wanted to know one thing. You said that WhatsApp does not generate any cash flow or revenue. Just wanted to know, like, I guess they have this similar model like Facebook, where they keep a record of our online like conversation, and they generate some database out of it.
So which company is that?
WhatsApp,
Or WhatsApp?
yeah.
Now, before Facebook acquired them, I seriously think they have no real revenue. And then, but then they keep growing and they keep getting investors' money, and then they actually get acquired. But they were successful in the sense that it was a must-have app for a lot of people, and it was generating a lot of traffic, and people are using it for communication. So no, they were not generating cash flow from by themselves. They were seriously relying on investors' money at that time. It's just like Uber, just like WeWork, just like YouTube, just like Instagram, that they were not actually making enough money and keep relying on investors' money. But now, of course, if you look at YouTube, I think they now break even. Now YouTube has has contributed a lot of advertising revenue to Google. But the cost of running that service is also very, very high. But then if you are Google, you have a lot of synergy because you just run a big infrastructure, and then you can then run a lot of bandwidth consuming, storage consuming business, because you have a massive scale. So this is also what they are banking on. But for Facebook, acquiring the user base, cross-referencing a lot of things, because now when we use WhatsApp, Facebook, Instagram, they get to know a lot of things about us, right? I think, and so this is how they can sell a lot more advertising and so on. Although it's not on WhatsApp, but they know a lot of things about me. Now hopefully, I think WhatsApp doesn't scan the content of our conversation, but things like Gmail, they actually they even tell you, right? They do use machine to scan content and try to sell us advertising. Even Google has even admitted that on some occasion there will be a human reading your email. This is something that they have already admitted. For some party services, there will be but I mean, we can argue whether that's right or wrong. In my mind, I don't like that, but that's a different story. So what I'm saying is, WhatsApp, even today, I don't think they generate revenue or cash flow directly. There was another question whether it has to go IPO. Oh, the answer is no. As an angel investor, I am very happy to exit at any stage. Even if a VC come along and then they say, hey, we want to invest in this startup, but we want to kick out the previous angel investors, I am happy if they give me a good kind of a return. So a lot of the time, the startup doesn't have to go to IPO, because it might get acquired by a competitor or by a large company that would find your company valuable to be added to their portfolio. When that happens, as an angel investor, that is an exit event for me. Now, of course, in every time when that happens, I hope that I will get a good return. Meaning, if the company get acquired by a competitor, I hope they put a good price tag. If the next round of investor want to clear out the previous round of investor, which sometimes happen, by the way, let me explain why. Because a startup, sometimes they have been desperate. Sometimes they have a lot of friends and family, investor, or fools, right? For VC, when they look at the list of investors, sometimes they're very picky, because there's also a next round after them, right? It could be another VC of a bigger size, the next stage, and so on. Every round, we are looking at who are the investors on, because in some way, you are shareholders, they are shareholders, right? So sometimes when it comes to making big decisions, you have a say, you have a vote as well. So they want to make sure that there are people who are no nonsense sitting on the shareholders list, because when it comes to some decisions, they want people to be more professional, they want people to be more value added. So sometimes they want to clean up the shareholders kind of book, right? So let's have people who are only sensible, they give the previous round some return, and then thank you very much, please don't influence the company anymore. And sometimes because in some countries like the US, I think if you have more than a certain number of investors, I think in US it's 100 or 200, in Hong Kong it's 50. So I think once you get past a certain number of investors, and then you have to start reporting your finance to the regulator, like as if you are a listed company. This is to protect the investors, of course. So therefore, you can't have too many investors. If you do, then you have to start reporting your financial to regulators, and that will be very something that's very troublesome, or a nuisance. So therefore, at different stages, the investors might want to ask the previous investors to get out and give them some good return. So this is why it happens. But in any case, no, you don't have to go IPO. I'm happy to get an exit at every stage. Okay, how to allocate shares sold to investors. Okay, this will be a topic that I will cover later on in this presentation. So I'll get back to that. Now, so for now, I want to talk a little bit about why VC cannot invest in small startup. Now, let's look at a few other slides, and then I'll cover that. Now, what would be a typical size of investment? Right? For angel investment, I know it can be even as low as $5,000 US. Actually, I use this number because this is how much the professor in Stanford have invested in Google when the two founders were looking for startup investment. But imagine you were how much that $5,000 US in the very first day of Google has turned out, right? So why not? I mean, they need the money. They try to find people to invest, and it could be as little as 5K. Of course, this is the extreme side, right? But typically, it will, for angel round, it's not going to be bigger than 2 million. In fact, most of them will be less than 1 million US for angel investment. The reason being, this is the very first round. There's no reason why a startup company would need that much. Very few companies at that stage require that much money. So number one, that's why the size is small. But number two, for angel investor, the risk is extremely high. I mean, if you're a VC, you already look at a company that probably have break even. Then it's working. It's a bit more mature. If you're a VC, you are looking. I mean, if you're a private equity, you're looking at a company that has been running for years and have expanded, and so there's a lot more track record, right? So for angel investor, you are looking at a company where there's no track record and you're making a big bet. So it's not wise to put too much money anyway. So they don't need that much at that stage. Two, you shouldn't be putting that much in this stage. So therefore, it's typically less than 1 million, in fact. Now, angel investor usually have no analyst support, meaning we are on our own. Although we are now seeing a lot more startup fund, which is more running like a fund, and they will hire analysts or associates. But a lot of the time, angel investors are on their own. It just someone who has some spare money. Even for me, as I'm not a high net worth. We are just interested and have some spare money to play around. And I would even advise people, if you're going to invest, if you're going to be an angel investor, and unless you're really high net worth, otherwise you shouldn't even put more than like 10-15% of your asset, of your total asset. It's just too risky. It's not worth putting that much money, taking that much risk. So anyway, that would be my advice. Now, angel investor usually are own money, but venture capital typically is other people's money. Yeah, they put some money, but by and large, it's more other people's money rather than their own money. Because they raise funds and then they become the general partner, and then they actually solicit a lot of private, they call the other private investor, which will be limited partner. Okay, so the general partner runs the show, and then the limited partner are private investor into the venture capital fund that they don't actually run the company. But angel investors most likely are investing in their own money. And as I mentioned, okay, source of funding, just angel investors, their own money, usually some people who have some spare money or some entrepreneurial track record. Venture capital run as a corporate, pool money from institution or individual investor. The deal size, now I have to revise this, by the way. The venture capital, small one will do 5 million, but now the big ones can go up to even 100 millions. So, but you see there's a gap, right? I mean, if you are really looking for investment of 3 or 4 million, or even 5, you're in trouble, because there's no investor for that. No angel will invest more than 2 million. As I mentioned, 2 million is already a stretch, but there's no VC that will invest a small amount. So this is where we call a funding gap. Now, sometimes it happens to some company. They are not quite VC round, but they are way above the angel round. Then seriously, they are in deep trouble. It's very, very hard to find that funding. We'll talk about that later. Typically, we are looking at early stage, and therefore the exit, it could be more than 6 years. So we sit on that investment for more than 6 years. So that's why we do hope that it will go multiple times by the time we exit, right? Because we sit on it for so long. Venture capital, it could be 2 to 4 years that they exit, because after that it will be another VC round, maybe another private equity round, and the process in the angel round is less rigorous because there's just not much track record to look at. And so we have to be a lot more creative. We have to be a lot more imaginative and how we're going to do due diligence, what references we compare. But for VC, they should have a lot more to look at, revenue, track record. So the process is a bit different. And as I said, venture capital usually is a fund. Therefore, they would have analysts, they would have associate to look at the due diligence. But angel investors, we are on our own. Maybe we'll pull together a few co-investor and then we'll share the burden. But now we do see a bit more established kind of angel fund as well. Then they will have an infrastructure to look at. But in that case, the cost of capital is high because the venture capital investor, they are looking at high return. And so if you're running the VC show, you still have a lot of investor briefing, over your shoulder and say, when you're going to give me some return. And typically, we talk about the internal rate of return, the IRR. I think venture capital, the investor are looking at least in the range of, I would say, 20% plus. that would be that if I were putting money in a VC, they better give me IRR at least 20, 25 or even higher, because the risk is so high. If it's anything less than that, it's not worth it. It's not worth it. Angel investors, I think, would be similar. Okay, now let me explain a little bit why VC cannot actually invest less than 5 million or even less than 10 million. If it's just to throw, what would be your guess, right? What would be a small VC fund? How much money do you think in the VC fund is to consider as a small VC fund? How many millions of US dollars do you think would be a small VC fund? Anyone? 100 mil? Yeah, that would be very small. Yes, that would be too small. In fact, it would be very rare to have 100 mil, but it happens, right? So 100 mil or a more typical, let's say 200 mil, but 200 mil is a possible small VC as well. So even let's say 200 mil, right, to give it a bit more money. And then the next question is, now usually this is how an investment fund structure. When after they raise the money, they have an obligation to deploy the money, meaning they have to invest the whole amount. If I use 200 million as an example, they have to use up the whole 200 million within 3 years. Within 3 years. That's very typical. So if that's the case, that means if they split out the 200 million over 3 years, then they will have to invest at least 66 million every year. Okay. Now the next question is, if 66 million is the number that they have to invest every year, now the next question is, out of 100 business plan, or let's say out of every 100 entrepreneur who knock on the VC's door, how many do you think they would seriously look at it, take them to the next stage? So what you're saying is every like 1 in 5, right? So in other words, so for every 20 company they look at, they would then be a little bit more serious to look into and take them to the next stage. Let's say to the due diligence stage. Now then, what happened? After for every 20, sorry. So now the next question is, right. So every 100 company, there'll be like 5 companies that they look at it very seriously. So what about for every 100 company that they're looking at it seriously, how many of them do you think they will actually end up investing? So they passed the first stage. Now I have 100 companies that I'm looking at doing due diligence. So maybe 10. Now, even let's say, listen, let me be very generous, right? Let's say every 100 company they look at 10 seriously. And then every 100 company they look at seriously, they invest in 10 of them. So that means there is a 1 in 100, right? From looking at all the companies, and then I only end up investing in 1 of them. That is not atypical, maybe 2, but because there's so many companies, so many startups, they knock on doors and every day, right? For example, right? Science Park says their goal is to have 500 company at any one time in their incubation program. I mean, so this is the number that they're aiming at, right? So many companies that you see investing so few. Remember, we have 66 million to invest every year. If they say, hey, a company come and say, hey, I want 5 million. Oh yeah, I mean, I have 66 million, right? If I invest a 5 million amount, that means I have to invest in at least 13 companies every year. And remember, every 100 company, we only invest in 1. If I have to invest in 13 companies, that means I have to look at 1,300, company, I mean 1,300 company every year. The math just doesn't work out. I mean, I don't have enough resource. I don't have people, and the number just getting too big. So therefore, typically, actually now the VC would have to invest something like 10, 15 million per deal, because then the math becomes a little bit more kind of comfortable. So this is one of the reasons, very simple reason, because they have this 3-year time limit. They have a big fund to run, and therefore they can't invest in small sum. And so forget it when we hear a lot of people, government officials, they talk about the startup that has just started in the incubation program, and then they start talking about bringing the VC to look at these small company, and it's a huge mismatch. That's not how it works. So, but the thing is, we need a lot of small startups to start with and nurture them, probably through proper angel investment and other help and incubator, such that we will have more and more big enough startup to fit into the VC stage. It's a process. So we need to start with a lot of the small startup. Hopefully it will then have enough for the VC to choose, and hopefully there will be some big winner coming out of that. So next time, if you hear someone to talk about how VCs can invest in a very, very early stage startup, then you can tell them, no, that's not how it works. Now, sorry, back to the question. What happened then if you really fall into the funding gap? Which means you need 2 million, but then you can't go to the VC, come back in 2-3 years. You're stuck, but then you have to be flexible. So therefore, either you have to change your plan and, let's say, break it down to the different stages. Why would you need 2 million, in one go, right? As a startup, right? So you have to break it down, and maybe you have to replan the stages of your development, or you would have to find a lot more like angels. Now, it is a, there's pros and cons, right? Too many cooks in the kitchen's not good. So, but then you do need the money. So hopefully, sometimes even for Dark Horse, we co-invest, and a lot of the time there is a lead investor who has already done most of the due diligence. We just have to do some final check. So if you are working with some trusted co-investor, and they have a team, because your interest is hopefully is actually completely aligned, because they want your capital and they are in for the investment as well. And then sometimes it depends on also some angel investors will ask for a lot of things, like they ask for a board seat, but then you're a startup, you only have a limited number of board seats. And sometimes angel investors, even with a very small percentage, they ask for a board seat. If you have too many investors like that, you can't cater all these cooks in the kitchen, right? So I think with if you find one good kind of lead investor, and then let them to assemble the other investors, and then hopefully they are represented by this one investor rather than everyone wants a board seat and so on. That would make things easier. But but still, it is very hard for a lot of angel investors to pull together $2 million for angel round. So the advice is still trying to stage out the investment, rethink what you can do with less money, because the funding gap is very real. The VC is not going to look at very small company. So of course you can go the other way around. If you have a good reason that you can actually take more money, but I have to, at this point I also want to say, someone asked about how much shares, how to allocate shares. So I will touch on that now, and then we'll have more details later. If you are angel, if you're a startup, right? For me, I think you should not give up too much share at the very early stage. Meaning, I don't believe that a founder should be diluted to minority in the very first stage or first few stages. A lot of the time, being the founder, the reason that they can weather the storm, when I say weather the storm, I mean, running a startup is not easy, and it's challenging, and sometimes it's very discouraging, heartbreaking, because things usually go badly and then occasionally go well. There are more bad times than good times initially, because it's tough. It is tough. And so I will quote one of my friends who have successfully sold his startup, and then he came to come and talk to my students. He said, the reason that he, first he tried to plot for illustration, right? If you draw a graph of your emotion, being happy or sad, about your startup, if you draw it along the timeline, your graph is probably going to be mostly stay in, you feel bad about your startup. Your emotion is really low most of the time. And there's only 1 or 2 times where your emotions suddenly go, oh yeah, this is a great, things are going great, If you, he said he survived because every time when he hits a low point, he will still remember, hey, this is my company. If I'm going to turn it around, I'm going to make it great, and it's going to be my company, and so on. Imagine that founder who has been diluted down to become a minority shareholder instead of a majority shareholder. When that low point hits him, he's going to quit. He's going to quit. It's not. He won't. He's just emotionally. Why stick with the pain? And I'm already. I'm now only a 5-10% shareholder. Why put up with the pain, right? So emotionally, psychologically, you even as an investor, I mean, of course, we want to get more shares for our money, but in the process, if we destroy the enthusiasm, if we destroy the founder's energy or passion, then you are not helping the company. So I would much rather the founder to have good spirit and good stake in the company to make it big. I want to quote another example. One of the investment that we did, we invested in, at that time, it was a 24-year-old. She proved to be a very good entrepreneur, and she started a company that what you would call now to manage the KOL, right? Manage the key opinion leader, manage the influencer. So she was pioneer in thinking about that, and she was trying to influence. She was trying to her area is to influence the university students. So, but you need to bring in the customer. The customers are brands who are trying to sell things to university students. And so she would somehow manage, KOL, and she would line up brands who want to sell things to students, and so she has KOL to help them to actually sell. Now, at that time, she has done a field campaign. I thought it was quite encouraging result. And so she's from Hong Kong, but then she went through incubation program, accelerator program in China, in different places. I think one in the north, one in the south. So she was very serious, and she was very happy to work in Mandarin in China, even though coming from Hong Kong. And she has run campaign, so some initial success. So we thought, and she was very savvy and good entrepreneur. Now the question was, what valuation do we put on her company? We were going to invest collectively about $500,000 US. And so, you know, I'll tell you and this is okay because it's history now. We were going to put a $2 million US valuation on her company. So remember, this is a 24-year-old. At that time, she owns 100% of the company, and we're going to invest $500,000, and we're putting a $2 million US valuation on her company. If you think about that, on paper, that means she is worth $2 million US because she owns 100% of the company. We just put a $2 million US valuation on a 100% owned company by her. So that means on paper, her net worth suddenly just shoot up to be 2 million US. I mean, not a lot of people have a 2 million US net worth, right? So she's only 24, right? And then I have a conversation with my co-investor. I say, is it really right? You know, the 2 million, is that the right number? You know, because I asked how they came up with the number. It wasn't really based on revenue or anything, because they did one or two, or I think 2 or 3 campaigns that was successful. So it was more like what would be the right number to incentivize her, rather than a true valuation that was based on actual figures. So my co-investor said, and I was convinced. So he said, hey, Dominic, what do you think? If it's not 2 million, what do you think the number should be? Should it be 1.5? Should it be 1? What would you say if you think 2 million is a bit high? And this is what he said. I thought was very true. Now, as an angel investor, we are looking at a company. We are looking at people. We're looking at the potential. If we believe that this could be a $1 billion company, if you execute things and run things right, well, this must be the belief, right? We are looking at a company with potential, and we think it's going to be a big company. Okay, let's say even if it's not a $1 billion company, let's say even if it's a $100 million company, right? So if you invest in a company that becomes 100 million today, right? Does it really matter that much that you start with a 2 million valuation or 1.5 or 1? If you believe this entrepreneur can bring their company to 100 times or 200 times the current value, does it really matter what the current value is now, right? If it becomes a $1 billion company, and you say it's 2 million or 1.5 today, does it really matter that you make 75 million or 50 million? Seriously, and you put in only $500,000 and you make a lot of money? The answer is no, not really. I mean, what's more important is, do you think you have properly incentivized the entrepreneur, and you do think this entrepreneur has the potential, has the competence to make this company great? At the end of the day, that's what's more important. So therefore, my advice, and also, if you ever go to see an angel investor, if the angel investor is trying to take over a large portion of your company at that stage, I would not take the money from this investor, because they are not thinking straight. They are not thinking in what I described. They don't understand the importance of keeping the entrepreneur properly incentivized, properly keeping their passion, and they are thinking very short term. If the person you are investing has lost momentum and the passion to run the company, to take it to become a great company, then your money is not going to grow with that. So yeah, stay away from that kind of money. Okay, so let me take a look. Oh, okay. It's 11 o'clock. Let's take a short break, and then there's still a lot more we can talk about. So let's take 15 minutes. So we'll start again at, let's say, start again at 11:15. 11:15. Okay, I will stop the recording. 11:15. See you later. Okay, I want to share other stories also about angel investment. Sometimes I heard entrepreneurs run into some angel investors, and then they would ask for what's called the guarantee return. Now, I was told that this is a little bit more typical in China than Hong Kong, but sometimes you run into these investors. I would stay away from those investors who ask for guarantee return. Let me share with you a few stories. A friend of mine who's now very successful, he now runs a very successful big, in fact, I think they're close or just become unicorn, in fact, in Hong Kong. But he started another company way before, or he was one of the co-founders. And they actually accepted another investor's money, which asked for a guaranteed return. And what happens was then that investor, having this guaranteed return from the co-founders, he pushed for early IPO plan, meaning my friend's company was on track of doing good business, but it wasn't quite ready or to become a listed company because there's a lot more responsibility and you need to expand much quicker, and so it was just not their plan to go IPO that quickly. But because of the investor who has the guarantee return, meaning he would get when there's an exit event like an IPO, then he was guaranteed to make a prescribed percentage. And if that investor did not get the necessary return from the IPO event, then the co-founders who gave him that guarantee return would have to pay him out of their own pocket. So imagine now, why I say this is bad idea is because this investor actually now has a misaligned incentive with the rest of the founders, with the shareholders, other shareholders, because he would absolutely go for an early exit event because his return was guaranteed. He didn't care about whether the company was on track or should be doing IPO. He just want his money and get the return. Indeed, the story went. So my friend's company went IPO in one of the growth board in Shenzhen, I think, or Guangzhou, I think it was Shenzhen. And so this investor did not get enough of his guarantee return, and so my friend and other co-founder actually pay him out of their own pocket. So at first, when we congratulate him on listing his company, he said there's nothing to be happy about with that IPO because they end up actually making very little money. So why would they accept money like that, right? In a way, initially they were a bit desperate. So anybody come along and want to invest, they were happy to grab their money, but not understanding the consequences of the guaranteed return. So let me give you another example. If you've been in Hong Kong long enough, right, you probably know there was this ice cream store in Tai Hang Road in Tai Hang Do in Tai Hang Road near Causeway Bay. Have you been to that? Now the gimmick of that ice cream store is they use liquid nitrogen to quickly they make ice cream on demand, they make it so you can actually see them how they make the ice cream in front of you, and they use liquid nitrogen to quickly freeze the ice cream. Has any of you been to that or have heard about this ice cream store? It was in Tai Hang Road. It was very famous at the time. The reason that you don't see that place anymore was, now it was successful, and the product was, I tried it, it was good. I mean, whether it worth the extra dollar is up to you, but at least every night people were queuing up at the store and want to try this product that, you know, liquid nitrogen is very fancy, right? The guy who founded the company, he was actually a chemist, or farmers, in fact, by training. Now, what happened to his story was he, you know, having just one store in Tai Hang Road with people queuing up every night. So he thought maybe he can expand. Maybe he can expand. Yeah, this is the one. Yeah, to use liquid nitrogen to freeze the product, and so the ice cream was very, very interesting, and it's supposed to taste better. Now, so with that much demand, he decided to expand, but he didn't have money. He didn't have enough money by himself to expand. There was so come along this guy who want to invest and help him to expand. In fact, he said, okay, we're gonna put this money in, and I want you to expand at least 6 more stores. So the flagship store, and then plus the 6 new store. But the thing is, he first not only he asked for the guarantee return, but also this is what went wrong horribly, because he demand that for every new store that they put up, they have to use his supplier of decoration, construction, and so on. And he was, I heard from the story, right? I'm not 100% sure, but the story went, these constructor, these restoration and, you know, decoration company were charging way higher than the normal market price. So do you see what happened there, right? Was this investor, on the one hand, they say, hey, I will come in and invest in your company for expansion. But then on the other hand, he's already getting the money back through this inflated construction decoration company that he recommended. And then, of course, even though, I mean, it was a good gimmick, the product was good, you know, pricing questionable, but whether it truly has demand for like 7 shops, right? That was highly, highly questionable. And so the story went, no, they didn't generate enough sales to cover all 7 stores. And so the business was not doing well overall. But then this guy with the guarantee return, he started demanding his return. And so he won out and citing the guarantee return that he was given. So what happened was then the founder who came up with the whole idea, the formula, the way to produce the ice cream and so on, he had to pay this investor out of his own pocket for the guarantee return. And so, I mean, but remember, this guy already got a lot of the money back from the inflated decoration and things, right? So this owner has no choice, but in the end had actually closed all 7, including the original, the flagship, the first store. I think it's a sad story because he was a good entrepreneur, he had a good product, but he ran into a bad investor. So not all angels are angel. You know, if you ever start your company and look for investment, be very careful who you deal with. And sometimes you can do a due diligence on the angel investor, meaning what has he invested before? What do people think of him? And if you look at the terms and conditions that he or she set, you know, whether they are reasonable. You should also do due diligence on the angel investor just to see if it makes sense. Okay, maybe I will share one more story. Forgive me if I've shared this before, right? Now, remember, I was on the show of the I Am Boss show, and there were this two young men who started a noodle shop, but they have this special noodle that is a bit like the Yunnan mi xian. Anyway, they have their own recipe, and the product was good, you know. And they were on TV. They got some startup money, and so they went about and start their own noodle shop. In fact, they used the prize money that when they came on the show to buy out a small existing noodle shop place to take over, and then start producing their own noodle. And because of the publicity, because of the way they were quite likable, by the way, when they were on the show, and people think that these two young men are very genuine, very approachable, and they have a good vision. So it was successful at the beginning when they have the first, and then soon they actually they also opened a second shop on their own. Now, then someone approached them. You know, be aware. You know, when you get some fame and success, there will be people who come and approach you. So this guy came along and tried to sell them a franchise idea. Now, don't get me wrong. I mean, the franchise idea in itself is not a bad idea. It just means that you have to control your brand, control your supply, and you expand through franchising, and so there are more people involved, and they're running like their own business. I mean, the franchise model works like McDonald's, 7-Elevens also run on franchise model. But this guy, he wasn't really into the business. So his plan was, let's get the franchise up quickly. Let's sign up many people quickly. And so, but also in the process, let's jack up the revenue number. Let's massage and fiddle with the numbers, and then get a good accountant to endorse it, and then get IPO. So now, how do we know this is the plan? Because soon when they start signing up the franchisee knew, I mean, it just wasn't working. Meaning they don't really know how to centralize their supply, control the quality, and marketing and branding. And so these franchisee initially was not happy because sales was not good, and they have to start selling their own stuff rather than just selling this brand. And when the media caught the attention on this, they start to go undercover, and they approach them and to pretend to be a potential franchisee. So they were here to say, hey, I also want to open a noodle shop like yours. Tell me about the plan. So they were caught on camera about the plan, how they're going to just expand crazy, jack up this revenue, and then go IPO, and then everybody get rich. They were caught on camera. And so the press went public on all this, and of course, it went all downhill from there. Now, why am I sharing these stories? Because I think for startup, even when they have the right idea, even when they have the right product, and when they become somewhat famous, when they become somewhat successful, you will see bad people start approaching them, selling them bad ideas or bad terms. And if they are not careful, a success story could absolutely turn into a horror story like this. And I think it was such a pity, because I met I met them, and I just thought that if they stick with a small initial plan, if they just didn't become greedy, or at least being a little bit more cautious, then at least they would still have a shop to run today. And then they could have grown maybe at a slower pace, but at least it would still be there. It would still be a small success story. Okay, so be very careful when being approached by some, and it's just not all investors are equal, and not all angels investors are angels. Okay, so just continue on the other topic. Now, there are different type of angels now, and I mentioned there are individual angels, and we invest by project. So this is more the dark horse model. Yes, we are picky, we are very cautious because we have limited capital. We only can do a limited number of deals somewhat. And so the hit rate is low, but we hope to get for high return. Now, for other, there are more other angel investors where, for example, the wealthy angels, usually they probably have done their own startup, and also they even start an angel fund. Now they will run this more like a fund, and they have a little bit more, well, certainly more capital, so they can invest in more deals and spread the risk. But again, they also look for very high return, but the hit rate is also low. Meaning they still be very cautious in what they invest. So typically very low hit rate in terms of number of investment, but also high return. And there are third type of angels where I'm talking about not these, because they are very experienced people, they get share grants rather than, so they, instead of putting money, they put time. They are the value add angels, where the company want to have these advisors, senior people on board, and then they give them shares in return. So they don't need to put money. So these are the different type of angels. Oh, by the way, one more thing. When I'm talking about angel investment here, I am typically talk about the scalable, the expansion, rapid expanding company, the scalable. But there, you can also have angels who invest in small businesses that they are not looking at the capital gain that they will get out of the investment. They are more looking at, they are investing in a business that will generate cash return. So you can be quite profitable, but you don't expand your business. So even if you open one cake shop or restaurant or something that is very profitable and you don't ever expand, there's nothing wrong with an angel investor investing in such business as well. But just to know that they are not looking at capital gain, they are looking at the steady dividend or cash flow that is coming from the profit of the business. So that would be like investing in small businesses. We are talking about investing in the scalable, expandable business. So now here's what I would like everyone to guess. I'm going to show you 7 pictures. I call this from pitch to hitch because in a way, this is how I would look at almost in terms of order of importance. What factors as an investor we will look at a startup, and I'll show you this picture one by one, and let's have a guess. What do you think those factors are? Okay, number 1. What do you think this is? When investor is looking at a startup, what do we look for? What do you think this is? Anyone? The team, yes. Well, more like, yeah, the word is the team. Because I mean, very, very, very importantly, we are investing in people. We are investing in people. So we look at the entrepreneur and we see, are they, you know, are they enthusiastic? Are they competent? You know, would they not rest until they become successful, passionate, you know, all kind of things. Also attitude, right? The thing is, when we now, I mean, the thing I just mentioned, right? Passion, competence, and all that. Of course, they are all the positive quality. But there is also something interesting about. Do you think the entrepreneur should be coachable? Now, here's the thing. We want, on the one hand, we want the entrepreneur to be very opinionated, to be very, you know, strong-willed and subjective. But on the other hand, right, you are going to invest in them. And if you do believe you have some experience and you may be a little bit more experienced than them in some area, I also want to know whether they are coachable. Do they take in good advice, or would they just do everything on their own? Now, this is a hard one. As I said, you want them to be highly opinionated, but then you want them to be coachable. And those are opposing kind of quality in some sense. But anyway, back to the question. Yes, number one, we are looking at team, the people first. And so number two is easy, right? So what's number two? When we look at the startup, the idea, yes. So, but don't get me wrong. I put team above idea, but of course, idea is also very, very important. But if I have to rank them, people first, meaning you can have the best, the worst. Let's try the other way around. You can have the greatest idea, but if the team is not up to it, then I don't care how good the idea, it's not going to work if the team is not working. On the other hand, you don't need a perfect idea if you have a great team. So a great team can then try to navigate and improve the idea. But even if you have the perfect idea with a not so good team, you wasted the good idea. So team first and then idea. Okay, number three. Now this one you've seen before. So it just means I want to see if the company has any unfair advantage, right? Remember, you know, of course, this is a basketball game, right? So because the investor is taking a lot of risk, and they can pass, they don't have to invest. So if they don't see a team, I mean, the company that really has some advantage, then the risk is too high, because I can always invest in another company. And by the way, for startup, if you really don't have any edge, then you're just a me too. So it's very hard to kind of differentiate yourself. So therefore, we need to see if the company has some sort of unfair advantage. And it could be the speed to market. It could be they have patent. It could be they have the right channel. It could be a lot of things. But if we cannot even name a single unfair advantage about the company, then the risk is too high. But the chances are they won't be very successful anyway. If someone else has some unfair advantage. Okay, number four. Now, okay, this one I must say multiple interpretation of this. So let's see, what do you think? This is a glass of water on the desert. Let's see, what would you think? No, these are good guesses, I get. Yeah, it's good guesses. But not quite the one I want. But you are actually you know, good guess. I mean, you know, whether there's demand. Certainly, if you have a glass of water in desert, then definitely demand. Now I'm taking a different angle. Yeah, exactly, right. So actually, no, we get closer. We are giving the entrepreneur the money, but if they are actually crossing the desert, is that enough for them to get to the next milestone? I want to make sure that the money that they are asking for can indeed get them to the correct stage. Because sometimes they ask for too little. Sometimes they ask for too much. But I mean, if they ask for too much, at least they won't die. But if they ask for too little, it won't get them to the next stage. They won't cross the desert with just one glass of water. And you know, I mentioned before, if they need money and they start looking for money, it will take them 6 to 9 months before they actually see the money. So I don't want them to be in the state of looking for investor again in a few months' time. Because it's just so distracting. I mentioned a few times where some entrepreneur, they just keep spending time to knock on investors' door, doing pitches, presentations, when they should have been really running and developing their business. That would be so distracting if they keep needing to find funding over and over again in a short period of time. So I want to make sure that they do get enough money to cross the desert. Okay, number 5. This one should be easy for those who use a lot of like Photoshop or other, you know, or editing your photos. What does this mean? The word, yeah, growth, but the word is a little bit different. Not just growth. No. What do you know when you use Photoshop or other things? This icon, it means scale. So yeah, scale. We are scaling. Is it scalable? And a little bit not quite like growth. I mean, yes, similar, but scalability. So something that can actually scale. When we say scale up, it typically means a lot, multiple times. As I mentioned, for there are different type of angel investor, but we are looking for something that is scalable. Now, okay, number 6. Now, I'm looking at the this one is for more like healthy financial, the underlying financial, the principles, you know, the whether it's a profitable business and so on. Because you could be scaling up a money losing business that you're just going to bleed faster, right? But we have just mentioned about, you know, yes, there are exceptions. If you are Facebook, you know, then you can buy WhatsApp even though they're not making money. If you are Uber, then for some reason investors keep believing in the story and they do, and they get IPO and so on. But on the other hand, hopefully I would rather, you know, invest in something like Zoom that we are using now, and they are profitable and they get to IPO. It's more a healthy underlying financials, but then there are exceptions. Okay, number 7. This one should be easy, right? Yeah, exit, right? Now, but then we are just looking at the investment and we are already looking at exit. What does that mean, right? Well, no, I don't need a definitive plan of how I would exit and get the return, but I need to get a sense of, when I look at this in this startup, what would that exit look like? Now, if you think, well, this company is in the right area, that it probably can go IPO at some stage. Okay, that's good. The IPO is the exit. Maybe we are looking at a company that, well, it surely will be attractive to the existing big player. So it could be that if you, I mean, it's quite typical in Hong Kong, you see startup where they simply bring an idea from overseas, and then, but it's just that they have not come to Hong Kong yet. So they start this same idea, and then if they reach certain size and shape, then it will get acquired by that company. So this has happened many times. We have seen auction sites like this that was eventually taken over by eBay. We have seen some social media site that taken over by Facebook or Google, and we have seen small travel agents, travel sites, right, booking sites that was then eventually taken over by Expedia or Ctrip or things like that. So I just need to know or get some sense of what would that exit look like. But if you really can't think about, hey, who would want to buy this, or would this actually get to IPO, then if you can't really see that, then you are a bit stuck. And to be honest, as an angel investor, we are not looking at the ultra long term of like staying with the company. We are looking at some point to get an exit. This is what the angel investors are thinking about. Same for VC, same for private equity. So this is not like I'm not investing in my family business, right? So and now you see, if you look at how the investor looking at the startup, right? So when you actually sitting on the other side of the table, if you are pitching to investor, this gives you some idea of what they're looking for. So tailor your presentation to answer these questions. Show them why your team is so good, so passionate. And the idea is great, right? Your team has unfair advantage. The finance is sound. And you're going to be so scalable, and the money that you're going to take will take you to a proper stage, and and some sort of return. What does that look like? The exit could look like for the investor. So I'm telling you what the investors look for, which means if you're doing the pitch, try to match the expectation. I mean, you don't have to follow all 7 points, but certainly some of them should be included. If you follow the Guy Kawasaki outline, you will already cover most of this anyway. That's why I thought it's a good template to use. Okay, now we should have a lot of time. So let's talk a little bit on how to deal with the angel investors. I mean, the deal terms and so on. Now, someone mentioned how to allocate shares to the investor. So let's deal with that. Well, it's just like anything, buying into a company, investing. It's like buying something, shares, and buying an item is no different. We need to know the price. But when we put a price tag on a piece of clothes or a computer, that's a price. When we put a price tag on a company, it's called the valuation of the company. So how much do you think that company is worth? So in a way, you can look at it, right? So if I buy the whole thing, right, today, 100%, how much is that company worth? Now, for those who are in finance, you can tell everyone, how do we put a price tag on an established company or a listed company? What do we say how much the company is worth if it's a listed company? I think for those who do finance would know the answer, right? For a listed company, it's worth how much? And we actually call that capitalization, right? Anyone? So for a listed company. No? Well, for a listed company, we say it's simply supposed to be the share price times the number of shares. Exactly, yeah. That would be a listed company. Now that means we let the market decide. People decide the stock price, and if you think it's too high, you don't buy. If you think it's good investment, you buy. And then someone think, no, I have enough of this, so I will sell you at this price. But that determines the stock price, and then you times the shares that give you a company valuation. Now, do you think it's right or wrong? That's up to you. It's very subjective in a sense. But now, let's say it's not listed. It's private, and if it's an established company, meaning It could be, let's say, let's typical example, right? Let's say you have a mobile phone company that is not listed. How would you value, how would you put a price tag on how much is this company worth, right? And then we'll talk about a startup, right? Hey, let's say, yeah, mobile phone company that is not listed. How do you value or how do you put a price tag on that? Yeah, sometimes people look at using stock market, they will say, hey, let's put a price earning ratio. Maybe that's one way, right? So you then look at the, or if it's price earning, then even though it's not listed, right, you say, hey, how much money were they making? And the typical price divided by earning ratio in that industry, and then you say, hey, so they were making this much money, so I multiply the PE ratio, and therefore this is something that how much they worth. Now that is another way. Yeah, I see a lot of like, yeah, using competitors valuation. That's called benchmarking. This is also valid. We are trying to use different ways because there's no right answer. Then we try multiple ways that make sense. So if so and so has done a valuation before a direct competitor, and then we look at the number of subscriber versus our subscriber number, and then so we can also look at the number of subscriber times what we call the net present value, NPV of contribution of each subscriber. Then you multiply that, you get a number. So we will use multiple ways. And for future growth, some people use what's called the discounted cash flow, DCF. If you ask accountant or finance people, they will tell you, yeah, DCF, discounted cash flow. How does it work? It works out all the free cash flow of a company, and in some projection. So you project into what, 10 years, 20 years, and then you say, but then we are not in the future, so let's discount all that from the future growth, and then you say, oh, we discounted the true present value, and therefore it's worth this much. Now, yeah, you can use all that for established company. So it comes back to the question, hey, how do we value a startup, right? Because we have none of those. There's no earning. It doesn't even have subscriber or customer. Do you believe their future growth potential? I mean, the projection. So we can almost like do no proper calculations. So yeah, you can do, one thing you can do probably is a benchmark, right? So we heard from the market that some typical company, similar company has been valued this much by another company, the investor. So you try to use these sort of benchmark, but at the end of the day, as we know, none of them are right? Because this is purely estimation and depending on what story that you believe. So at the end of the day, it's an art rather than science. You just use a lot of guesswork. But remember the story I share about the young entrepreneur. The price tag was 2 million. We don't even know if it's the right number. But who cares if that 2 million really become a billion, in some years later, right? So it's a lot of guesswork. It's all come down to negotiation. But the factor that you take into account is, first, do you think the company will grow that many times? So whatever number you start with and whatever number you think it's going to end with, is it going to grow that much? Whatever amount the investor put in and the valuation you put today, does that mean a lot of dilution to your shares? These are all the factors that are, I would say, not really science, but considerations, and to come up with the right price tag. Now, but what does that mean, right? So how much do you actually get, right? Well, it's like a very simple math. I'll just verbally use an example. Remember, I said the entrepreneur, the company, we put a price tag of 2 million US, and collectively, the investor was going to put in $500,000 cash. Now, so in the finance term, the 2 million valuation is called pre-money, and we put in $500,000 money, cash. So the post money is simply 2.5. Makes sense, right? 2 plus 0.5. But again, how we come up with the 2 million, that's the art. How we get that. So therefore, afterward, the investor collectively should own 0.5 divided by 2.5. Which means after the transaction, we own 20% of the company, which means the entrepreneur who owned 100% before with the 2 million valuation, because now the post money is 2.5, so she owns 80% of the company. That's how it works, that post money, pre-money. So the key thing is, I mean, you always know for sure how much money you put in. That's the investment. It's just that the valuation is the art part where you have to agree. And remember, I would strongly advise against great dilution of the founders, simply because that destroys the incentive. Now, does that mean it's not fair to the investor? No, I think what's important is what my friend said. How much more values are the entrepreneur going to create? So in other words, I care much more whether this pie will indeed grow to a huge pie, rather than how big a share I get now when it's small. I would much rather to have some good shares of a very big pie than a very large share of a very small pie. That makes sense, I hope, for everyone. Because at the end of the day, it's the growth, the scalability that would be most important for a startup. But not to say that if I'm unfairly getting too small a share as an angel investor. Now, let's say a typical number. Like if angel investor, after the investing, if the angel investor only get like 1, 5, 10%, yeah, that may be, on the other hand, that may be too small for the investor. So you have to make a balance. But I would say the limit is never, well, at least unless you are asking for a big sum from an investor. Otherwise, we should not dilute down the co-founder to less than 50%. That's what I'm saying. They should keep majority. By the way, some entrepreneurs are much better than others. If you think about this, it's amazing that you know how much Mark Zuckerberg still owns Facebook, the percentage. Anyone know? I mean, after so many rounds of dilution, so many investors come in, and then when IPO, another big round of investment, how much Mark Zuckerberg still owns the company? No, not that much. No, that would be super amazing. Yes, but it's already very, very amazing. Not 40%. No. I heard it was close to 25%, but that is already super amazing. I don't think Bill Gates owns Microsoft 25%. Does he? Probably not. No. Anyway, so that is super amazing. But also, of course, these days, WeWork tried that. Google has that. Facebook has that. They have this special class shares where it gave them 10 times the voting right. By the way, WeWork was trying to, if the IPO went ahead, sorry, even the IPO didn't go ahead. The founder of WeWork, he owns shares that give him 20 times the voting power. So in some sense, if you're a true believer of corporate governance, you would be totally against this sort of idea to give such a concentration of voting right in one person. It just doesn't have it doesn't have sufficient check and balance in my mind. And like a lot of them, like I think Alibaba also concentrate, and I mean, but you can see why a lot of yeah, you can see a lot of founders would love to keep controlling the company. It's understandable, but in terms of corporate governance, that isn't the best thing I think for a company, especially. Usually this is very much against the small investors' right. Now this is why as an academic discussion, this is how, you know, we keep using WhatsApp, Instagram as an example. Mark Zuckerberg, having 24% or I think something like 24% share, but with his special class of share, he actually has more than 50% voting right. So he has a majority of voting right. And that's how he can walk into WhatsApp and name a price as high as 19 billion. And so he can do every single deal single-handedly. He didn't need to ask anybody's permission. He didn't need to bring in any other shareholder. And he can name any price and do anything, acquisition just by himself, because he has more than 50% shares. The only exception is if it's a connected share, which means if the acquiree is also his company. So in other words, unless there's a conflict of interest, when he cannot vote on conflict of interest thing. So he didn't own anything, he didn't own any WhatsApp or Instagram share before. So it was not a connected transaction. So therefore, he could walk in and single-handedly to make a deal as much as $19 billion. Anyway, okay, so. Now, just one more thing about getting shares. Now, we just covered the concept pre-money, post-money. That would determine the amount of shares, but that has an assumption. The assumption is we are all buying new shares. Now, if for those who know about limited company, how shareholding works, of course there are. You don't necessarily issue new shares. You can issue old shares, which means someone else is actually just selling their shares rather than the company. And now this is very unusual at Angel Round. It might happen because at Angel Round, unless there are some co-founders who want out, or there's some co-founder who just not working out. I have invested in company like this, and so they have to first get the kick out some co-founders, or at least buy out the co-founders. But in that case, the co-founder that they are selling old shares, not new shares. The difference is if you're selling new shares, then the money totally go into the company. If you are buying old shares, then someone who owned that old share before is getting the cash instead of the company, which makes sense. And when it comes to IPO, you often see sometimes you are getting new shares. They are putting new shares up for IPO, and sometimes it's old shares. But usually that is a bad sign, because that means someone is not believing in the future growth or the future of the company. That's why they want out now. But it's a bit contradicting. If they are selling, IPO, that means, hey, we're selling a very high potential company. You're trying to get investor to buy into the future of the company, but yet there are existing shareholder who are exiting. Then it in a way doesn't make sense. I mean, it's a contradicting message. Okay, so Yeah. Oh, I just covered this. Yeah. New shares versus old shares. Now, also for investment, sometimes we don't buy the equity right away. We buy something called a convertible note. Convertible note typically have several things, right? It will state how much money we are putting in, and how it will convert into shares at what price. So these are usually have a prescribed formula. So maybe it says, hey, I will convert the shares at a certain dollar per share, and it will convert at after a certain time or when certain events happen. These events could be when the next round of investor comes in, then all previous round of convertible note will convert, and the price can be fixed, can depends on some other things. So why people want to do convertible note instead of shares? Well, there are many different reasons. Technically, if I have a convertible note, I am not yet a shareholder. And when I'm not a shareholder, I am a creditor. So if you look at the legal side, there are more protection for creditor than shareholder, because if you're a shareholder, you are not protected. If the company goes down, you're the last one to recover anything. You take the most risk. And convertible note typically also have sometimes have interest. So it's like lending money, but probably not going to get the capital back. In any case, it just get converted into the shares of the company. So there's legal protection, there's legal implication, and then there's it is a very typical instrument. So not everybody would invest and directly get shares. If they don't, usually you get a convertible note that will convert into shares at some later stage. And recently, one of my investment just call and say, well, they now have a next stage of investment, so all our existing convertible note has to be converted next month. So I'm fairly neutral about that, because from day one when we invest, we were thinking about getting the shares anyway. So I was okay. So now the event happens, and sometimes you don't want to sell your shares, because remember, shares are actually expensive. It's your upside in a way. So, and sometimes the investor may not believe in the business plan, but they believe in your cash flow and your ability to pay back a loan. So in this case, you are better off to take out a bridge loan rather than selling your shares. And well, sometimes why don't you go to the bank for a loan? Well, usually no banks will lend to startup. It's just too much. You are too much risk to them. So bank typically only lend to corporate when they have some sort of collateral and some sort of steady business. So bank, most of them, probably all of them, will stay away from financing loans to startup for that reason. I think it's right. Well, sometimes, yeah. Anyway, so banks don't lend to startup, full stop. I mean, they can be a banker, but they don't lend you money. And so therefore, investor would sometimes look for this opportunity. Typically, because of that, they would demand high interest. Yeah, but it's not for the bank to buy into your idea anyway, because they're not in that sort of business. They are in the money lending. They're not in the investment business. So therefore, I would say a money lending business shouldn't do investment, because it's just not in their mandate. They should. I mean, there could be another arms in the bank, or they probably would finance VC, but it's just I think each division should have their own focus, and that's just not the focus to lend to startup. Okay, so is there any other mode of investment? Sometimes they give you warrant. I get this incentive before. so the startup says, okay, if you invest in this round, you have the warrant to invest in follow-up round at a discounted rate. And why not, right? If you give me that incentive. And and because this incentive is interesting, because as an angel investor, the next round is probably not my area, because it should be the VC. It will be a lot more capital and so on. And it's a different risk appetite, different time horizon. So usually we don't get involved in a follow-up round. I mean, a VC could have 1 or 2 stages, right? You can have Series A, Series B, but for angel investor, so in that case, it was interesting that we were given an option to invest in the next stage, and so we did. But in that case, we didn't actually put more money. We simply convert the value of the option, and if you know what I mean, because we were given an option, then the option itself has value, and we simply using the value of the option and convert that values into new share. But in that case, we did get more shares without putting more capital. Okay, now if you actually see eventually get into a transaction, get an investment, this will become useful. Should you need shareholders agreement? The answer is I would strongly suggest yes, shareholders agreement. In fact, you probably at some stage should have a shareholders agreement before you have a new round of investor anyway. Now, what does that mean? Well, in the shareholders agreement, you can put a lot of things. Certainly, you can put some anti-dilution clause, which means nobody can buy more shares of the company if that same transaction is not offered to everybody. So, meaning you can't have one of the founders suddenly subscribe to a lot more shares to dilute down other people, because every dilution or every sale of shares has to be offered to every existing shareholder. So it's up to you whether you want to follow up and also subscribe the share. But there will be no situation where you are left out, that you are not allowed to top up your share ownership if there is an anti-dilution included. Now, if you watch the movie Social Networks, where they talk about how Facebook was started, you will see one of the founder was not given the anti-dilution clause, and he was outed. Well, he was seriously diluted down when he was not offered to buy more shares. And you see this in the movie. It's very interesting to learn something from there as well. But what other shareholder agreement term that you could put? To give you an example, oh, you mean the story? Yeah, okay. But anyway, other shareholders agreement that we could put, right? Yeah, I mean, when you started the company, you start with friends and colleagues or partners, and you all have the same idea about how you want the company to grow. But what happened? Because this is a shareholders agreement that every new shareholder have to sign. What happened if you start bringing in the wrong people, or unfortunately you're not, now, for example, if one of you want to get out, I mean, co-founders, and you say, hey, I need the money back, I'm in a different situation, or we don't work along anymore, and so I want out, right? It happens, right? But then what shall we do with the shares that this person owns? Now, sometimes shareholders agreement will dictate that no one can simply sell their shares to outsider. So typically there might be something like first right of refusal. So meaning one of the shareholders, if they ever want to sell their shares, they can only sell to other existing shareholders. Now, in some sense, it protects that you're not going to sell to the competitor, for example, right? If one of the co-founder gone rogue and fall out of with everybody else, then say, hey, I'm going to sell this to our competitor, right? There's nothing wrong. There's nothing to stop him if there's no shareholders agreement, because it's his share. It's a free will, and so if someone put the price right, why not, right? So unless he's bound by the shareholders agreement, you see. So now sometimes, I mean, in that example, it's a bit of a hostile situation where one of the shareholder want out, and then so right. But there are other situations, just to name you a few. What if one of the shareholders got run over by a bus, right? So and so his share becomes an estate, becomes an inheritance, and whoever inherit that say, I want out, or maybe that person, maybe the son or the wife, or they may not have the same kind of vision for the company, and maybe they want to sell their share as well. So again, these clauses in the shareholders agreement is designed to protect the company, and also to protect the interests of everybody. Another example, you don't even have to have the shareholders to run over by a bus. What if one of the shareholders is going through a divorce? Then his or her shares in the company become the subject of a divorce settlement. And so this share now, yeah, exactly like Amazon, well, they have a peaceful separation. I hope it sounded like they had a very mature decision, mutually agree. But anyway, that is these are not uncommon. This happens. So we don't want the company to get disrupted by this, and so we start having people who don't share the vision, or even hostile, or so you can put a lot of things that you can think of in the shareholders agreement to protect the company, to dictate how shares before IPO, how shares can change hands or cannot change hands. Anyway, that's but also memorandum and article and things, right? This would dictate how, for example, how many board of directors, how to make decisions. Is it majority? Is it like Mark Zuckerberg can single-handedly make all decisions, or if there is any counterbalance, or how major decisions are made, right? So that would be a typical. But in any case, right, these are not uncommon in any company anyway. But for startup, I think shareholders agreement is very important. This will also dictate every future investor that they have to comply. Okay. Another interesting area is if you have a startup, when you start the company, you probably start something simple. So there is no consideration of whether you have a multi-layer structure of your company. You probably have just a single company. But as your startup grow, especially when there's several situations, right? One, maybe you have some sort of IP protection, intellectual property, a patent or something, or trademark or something. Maybe you are now expanding overseas, then you're bound to have another entity overseas. Then these structure become important. How do you structure your global business? So different type of consideration, right? If you have more overseas company, should they be, where should the holding company be? Should it be in just Hong Kong, or should the holding company be in an offshore company in a tax haven, or Cayman Islands, Bermuda, BVI, which is British Virgin Island, or Jersey, Channel Islands, where would you put your holding company, right? And then so there are reasons for that, because you just, you have to consolidate the profit, or you're going to pay local tax every places. If you look at Apple, Google, they always try to find the lowest tax, right? I mean, it's only typical and within limit and within the law, right? But then there are other situations where you have a operating company where they actually run the business, but you don't want to put the trademark, your IP, in that same company, because the operating company may run into some legal issue, consumer issues and things, right? If you ever get sued, then if it get your intellectual property, your trademark and things get entangled into the operating company. So again, some company would say, hey, I put all the intellectual property, I put the trademark, I put the thing in one layer of company, and then you only license the right to operate to yet another company. So if anything happens to the operating company, at least your IP is safe. Well, you could even just liquidate the operating company and start another operating company in some other places. It doesn't at least it doesn't affect your trademark and things. So there are multiple reasons why you might have a multi-layer structure. If you do business in China, for example, right? I mean, yeah, if you have multiple lines of businesses, right? And now, let's use China, for example, right? Because if you're coming from outside and you're not a local company, then usually you would have to set up what's called a WFOE, right? The wholly owned foreign entity, and then you own a local company. But there are implications of who can be the director of these companies at what level. So there are also the reasons, right? Now, typically, there's a question about, holding company in tax haven. I think it depends on the, if you look at a lot of these companies, they start up especially, they are probably indeed registered in Cayman, Bermuda, BVI. In US, the tax haven of US is Delaware. So you do see a lot of company. I remember, I think McKinsey is also registered in Delaware. So there's nothing to do with the brand actually, usually, but it has a lot to do with the tax, and also there are some tax haven is easier to do IPO than others. That you have to ask accountant or lawyer to give you a better picture. But in China, foreign company, local company, different layer. Now, but why I'm talking about all this, my main point for this, because we're talking about startup financing, is not to advise how you should structure your company organization, but rather, if I am an angel investor, at what level do I invest? Now, you see, this is a very important question. As an angel investor, if I am investing in your company, for my maximum protection, of course I would like to invest in your holding company, because that's supposed to be like everything, and also it includes your future kind of diverse business and so on, right? But you may not want me to invest in the holding level. Maybe you are only offering to invest in one type of business at a local level. It could be just one local operation in Hong Kong or Singapore or in Shanghai or in Europe or somewhere, right? So it depends, right? So it's a negotiation, and also it's where the investor's interest lies. Maybe I believe in your business in Asia, but not in Europe. So I want to only invest in your Asia headquarter or Asia holding company, right? There are all sorts of reasons. but also maybe I want to invest where you're holding the intellectual property, where you hold a patent, because I think that's going to be the place where it generates profit. But maybe you don't want me to own that, but then you are offering a very attractive deal just at the operating company, because I don't need to own your IP. I just need to run a business out of using that IP. So these are very different considerations, and so you have to think carefully. Are you allowed? I mean, are you letting in the investor in at what level and why? And also there will be different implication, of course, on future expansion and so on. So this is one thing that I mean, for startup, initially probably you don't need to think about this. There's just one company is starting, and you're offering that the shares of that one company. But I would look. But if I were the investor, I would be very careful. Am I investing in just a empty shell company, or am I actually investing in something that holding true values, or or intellectual property? Okay, I think I mentioned a few of these already. The investment. Oh, and whether there's some incentive, as I mentioned, future options. In some countries, to help the startup, they may even offer tax break in some places. Should I get board seat? I think it's, to be fair, if I as an investor, I come in and I got a significant amount, like at least like 15-20%, then of course you should get a board seat. But if I'm in and I'm only co-investing and I only own 2% of the company, I don't think it's fair to get a board seat. But at the end of the day, it is a negotiation. So maybe some investor has a strong will than other, and they fight for this, or they're out. It's a negotiation. And oh, okay. So let me just use the rest of the time to talk a little bit on how or what deal we have done, just to give you some examples. Well, first of all, where do we find the deals? By referral, by meeting them in conference, seeing some of them in accelerators, and once you also try to be speakers at some events, then you get to you become people are aware that you're around, join some association and so on. So I will just go through some of these ones that could be interesting. Well Friends was the very first one that I that invested. Now they're not doing so well, and I think they're not really operating actively anyway. But that was the first deal that got us into investment. MePhone was actually a online English teaching platform, and later on trying to start Mandarin. More and More Yo-Yo. This is actually a online pet food and accessory store in China. I want to talk about this one a little bit. When we invest in this one, they were at the stage, we co-invest, by the way. They were very successful, I believe, in Beijing at that time. The metrics were really good. Repeat sales, SKU were good, delivery time, customer review, everything was quite well. And so they just need more capital to expand beyond Beijing. So this is when we co-invest with a very leading investor in China, and they did well also in Shanghai, but then they went through a few years of like stagnation. It wasn't growing, but the company was doing enough revenue. I think it was in the hundreds of millions of revenue, but it wasn't really growing too much. They also move online. I mean, not from their own platform. I think they moved on to Jingdong and Tianmo, but then it wasn't really growing. And then the founders were having a lot of family issues, And so in the end, we got out because the founder actually bought out all the players. To us, I think that was fair enough. It was fair enough. We make some money out of that. I mean, it didn't expand or IPO as we hope, but at least we got bought out and with some return. So that was quite decent. Okay, there were others that were not so successful. This Youshi was the one that's trying to be a Chinese LinkedIn, and it was in fact a spin-off from the WealthFriends. So anyway, now, okay, let's talk about this one. I want to, the Biomedic, the ClearBridge Biomedics. Now, this one actually got IPO, so we were quite pleased. Just let me describe it. First of all, how we got to know this company. As I mentioned, one of my partner was Singaporean. He's also a friend of mine from Cambridge days. We know each other from back then. And so it was a time where Singapore government launched several incubators. Government not sponsor, but they try to get commercially run incubators, but they have a fund where they will co-invest with the incubator. So my friend Johnson, he actually he bid and won the right to run the biotech incubator, and so he starts sourcing a lot of the biotech related investment in Singapore, and this is one of his investment. And then he shared with us, and he said, "Hey, why don't you guys also invest in this company?" So all the ClearBridge one come from the same incubator by my friend who's running it. Okay, so what is Biomedics, right? It's a liquid biopsy, and let me describe this. Imagine you go to you want to check whether you have cancers. You don't want to do a screening before you do a more deterministic test, and so you can go to a clinic, any clinic with this device, because the device is only not bigger than a printer. And so you go into a clinic, you take a small amount of blood, and you put this blood into a cartridge, and then you slot this cartridge into this machine. Remember, it's just like a printer. And then after some time, not too long, it will give you an analysis, and it can tell you whether you have a particular type of, potentially you have a particular type of cancer. The way it works is, first it licensed a technology from MIT. It's called microfluid. And when you take the blood sample, they put through these microfluid devices where it will separate the content in your blood, and it will trap what's called the circulating tumor cell, CTC. Typically, when someone has cancer, some of the cancer cell will shed and enter the bloodstream, and so hence the name circulating tumor cell. And the chances are there will be some, but you have to catch them to see whether they're, and a small amount of the blood would be sufficient to catch these cells if they are present. But the traditional way, before using liquid biopsy, using microfluid technology, you use what's called some marker chemicals, and if they will bind to the cancer cell, and then they will change color, and then you can see whether they are present and something, then you can see, oh, there is this cancer cell. However, using that kind of method, you kill the cell. Yeah, you catch them, you mark them, but then you kill the cell. But using this liquid biopsy approach, you catch them live. So you can then actually do further analysis. You can even grow culture. You can grow and see what kind of cell and things. The point is, the whole process now becomes much cheaper, much easier to do, and because the machine is very small and it's not too expensive, so you can have a lot more like clinics or hospitals who can actually offer this sort of screening. And so if I let me paint you a scenario, right? So imagine people do body check all the time, right? So a lot of people do body check, and when you do a full body check, typically they take your blood sample and to do a lot of analysis. So imagine one of the tests now is you can perform is to do a cancer screening. So if this become a mainstream kind of diagnostics screening, imagine the market, right? Because it's not too expensive. It's you can be widely adopted. And if this sort of test becomes a mainstream lab test, think about that potential, right? So now when we invest in this company, it was, again, it's out of Singapore, but the one part of the technology was licensed from MIT, but the rest was patent and research in Singapore. And when we invest, it was in a stage where they were coming out with the prototype. And but now it got IPO, is already in production, is already in some clinics. And also I met independently people who are in Hong Kong who were collaborating the research. I didn't tell them the name. I didn't even know I was talking to a collaborator on the research. I was simply describing one of my investment. And then the professor in Hong Kong, you actually asked me, hey, are you talking about ClearBridge Biomedic? I said, yeah. And we are a collaborator, and wow, you are an investor. You guys are so lucky. Because in a way, wow, I was so happy that at least now, another researcher endorsed the finding, endorsed the technology independently. They have also done, they have collaboration research in US, in UK, Japan, and China. So they have quite a few places that are kind of collaborating and verifying the result. Now, eventually, they got a big endorsement of the Japanese equipment manufacturer. So the equipment is actually made by one of the biggest medical manufacturer in Japan. But that company spent 2 years on the due diligence just to make sure that, hey, you guys are really onto something real and marketable and things. And the Chinese partner actually is a company where they provide the financing for to complete the process of all the regulatory requirement. Now, of course, in return, they finance and will deal with the regulator and get all the necessary licensing and medical and regulation requirement. In return, they want to be the exclusive market kind of distribution right. I mean, it's fair because they're going to spend the money for getting all the regulation approval. And therefore, in return, hey, they want the distribution right. But that's a big endorsement in a sense. Now, yes, it went IPO, but we haven't sold the share yet. We think the real value add should come when the China market is open, and when they have a more I guess more adoption of the technology, and they continue to expand on the kind of things that they can test with this. Now, we don't overpromise because but they and also only focus on. I think right now at the beginning is just cancer screening. They're not. I don't think they're testing other things, so they're a bit focused on some area. So I think we would rather get to be very good at some area, or rather than mediocre in a lot of area. So hopefully, I think they stay on on path of the focus. Okay, just want to show you a few more. Now, however, the other you see we have 4 investment on the ClearBridge thing. 1 got IPO, and then all the other 3 are already terminated, unfortunately. So Oh, by the way, this is the launch pilot was the KOL, the student who started this. Now the story went no, it didn't become the success story that we hope. It ran out of money. I mean, they have get momentum, but they never generate enough income. But it was acquired by another company, which was a much bigger KOL kind of management company. So at least, well, we didn't have to write off that investment. So we now become shareholders of Robin8. ViewWider is also hopefully is a success story. Is still on track. When ViewWider was a science park company in Hong Kong, and initially they were focusing on just helping people who are selling stuff online, meaning if you are on eBay, if you're on Amazon, if you are on Alibaba, or if you are on Roku in Japan, or typically the shops, the merchandiser, they're competing with each other of how to list their item, what description and price and so on. So ViewWider at that time had an AI big data kind of system on optimizing how you can sell on e-commerce site. So if you are a customer of theirs versus if you are just someone trying to sell the same thing, then the ViewWider client would have supposed to have like much better optimization in terms of when, how much, what price and what description over those who don't use their service. And when we invest, right, they show us very solid figures of big merchants who ask them to test, to try to help them to push their product. And the result was fairly impressive. I think they continue to maintain that good AI algorithm and things. But they have moved on. Now they expand. Now they are not just helping. They're not just helping the merchandiser or the people who are trying to sell things. So I will tell you, this is the current model. They expand to be a much bigger since then. So now they are actually a platform connecting three parties. Number one is actually the goods manufacturer. So if you are a factory in China, a factory in Vietnam, or wherever your factory, you are producing stuff, but you may not be the right person to sell to end user. Typically, you are not. If you are a manufacturer, of OEMs and things, but you are not the one who know how to sell direct. No, that's party number one. Party number two are, again, the people who are trying to make a living, big or small, online, that are selling on eBay, Amazon, Yahoo Auction, all these people who have e-shops on the e-commerce platforms. So you and I, in fact, you can try this right after this class. Is you can now get on ViewWider platform and you can source all these goods and items, and then you can you can sell them on eBay, Amazon, Alibaba. So you are a merchant with no products, but they give you the supply of products, and you can just sell them. Remember, they are good at optimizing selling for merchants. So, but then now they are actually providing the product for you to sell as well. Then of course, the third party would be all the big e-commerce platforms. So they connect all this, and they are actually helping people to sell. It's very interesting. So, but anybody can open a shop, and But by the way, the shipping, this is called drop shipping in a way. So as a merchant, you don't even need to ship, because the manufacturer that you are selling the product will actually ship directly to the customer. So you are merely a salesperson in the middle, that you don't even need to stock your inventory. so they have done actually pretty good revenue on that because they get a cut on the every sales, and sometimes not just sales, sometimes it's just listing. They will help you to list an item and they get a listing fee because they optimize the way to list against all your competitor. Anyway, this is their business model. Now we were the first angel investor. So at that time, it was very hard to find other investors. I happen to know them. I believe in their model, and I think it was a good team. And we actually is a very value add investor because one of my partner helped them to open their office in China, in Taiwan, and in Vietnam and Korea. And now I think they are also in Turkey and some other places. So, and then in terms of investment, they have now got a VC round of investment out of a big VC in China. So for us, I mean, we have not exit yet, but we're happy that they have more investor, and we are very happy that originally, when we invest in them, they were just in Hong Kong. So now they're multinational. So I'm quite happy. Hopefully this could be a big one for us if eventually we get an exit. Hopefully, just fingers crossed. Okay. Actually, I'll tell you one more, and then we'll stop there. Just talk briefly about this Cathay Photonics. Well, we are a very, very small investor in this one because this is, you remember I talked about there's an elevator pitch event. So 2 years ago, Cathay Photonics was the winner of the elevator pitch event. So as an investor judge, we put in a small amount, which is only $10,000 US as a convertible note. So this is the company where just notify us that it's time that we have to convert, and so just we got notice of. But what was their idea and what did they sell, right? They have this technology where they claim they can produce the second hardest material on Earth. Now, everybody knows the hardest material on Earth is diamond. So they claim they can produce something that is the second hardest. So unless you scratch the glass, this material that they make, unless you scratch it with your diamond ring, otherwise there's nothing you can use to scratch this. So the elevator pitch was very simple. They show us the product and they give us a knife. So say scratch it, try your best, and you couldn't. So that was quite convincing, So imagine, he said, imagine using this to protect your phone. By the way, it was made like a flat screen protector. So it was very convincing. You are scratching this, look like a screen protector with a knife, and nothing happens. So very, very convincing elevator pitch. And so they have this pattern, and they can make it into production, and they have signed up partners. So you can use this to protect, of course, the mobile phone screen, the tablet, your computer, or your webcam, or anything that needs really serious protection. They're supposed to be cheap enough to. It's not an expensive thing, so it's supposed to be cheap enough. You can use it on every mobile phone and so on. Anyway, so this is just another. So, well, okay, you can get to see some of my partners, and we for ClearBridge, it actually won a very prestigious reward by Wall Street Journal with Credit Suisse of Asian Innovation Award a few years ago. So you see, actually, the guy in the middle holding the thing is the professor who came up with the technology for biomedic. He happens to be also, actually, I kind of know him. He's also from Cambridge. We were there at a similar time. Next to him also holding a prize next is Johnson, one of my partners. So in a way, myself also, the three guys who are holding the award actually are the Cambridge guys. And then the other three are my other partners. So you can say, yeah, you have to be handsome to be a dark horse. No, that's just a joke. But anyway, so the one other partner who couldn't come on that day. But anyway, so there was so 5 partners here plus the professor who came up with the technology for biomedic. So anyway, okay, I think that's all I have for this week. I hope that by using Dark Horse as an example, it gives you some insight about startup financing, what investors are looking for, and some examples of how other startups. By the way, when you look at the PDF that I share, it's a different